Hello and welcome to Follow the Money. I'm Robert Tan. Here we uncover the stories and strategies of how money really moves. Today we're putting the Philippine economy under the microscope, from trade tensions and inflation to technology and jobs. As global uncertainty grows, the big question is, can the Philippines stay resilient, or are we just running on momentum? To help us break down the numbers and the regional outlook, we're joined by HSBC ASEAN Economist, Aris Dacanay. Aris, welcome to the show.
Hi, Sir Robert. Thank you for having me.
Thank you. Now, Aris, let's start with this. With global trade tensions and tariff wars resurfacing, how exposed is the Philippine economy, and what's the real impact on ordinary consumers today?
Actually, to tell you the truth, amongst the ASEAN economies, the Philippines is actually the least exposed. And I think we need to look at the job numbers to see how resilient, or at least how insulated we are from the tariff headwinds ahead. So case in point, our manufacturing jobs as a percent of total jobs is just around between 8 to 10% of our total labor market, in contrast to Vietnam, Thailand, and Malaysia, where around a quarter of their jobs are focused on manufacturing. And as we all know, tariffs or at least services are not tariffied. It is the manufacturing of goods, the exports of goods. So it is those manufacturing jobs that are feeling the brunt of these tariff headwinds. So for the Philippines, we are quite insulated. In our forecasts, we've just shaved off around 0.6 percentage points of growth, mainly because of US demand buying less from Philippine goods. But at 0.6%, we are in a better place compared to all the other ASEAN economies.
That's good to hear. Now, if we talk about inflation, Aris, it may be slowing down on paper, but for many households, prices still feel high. Are we mistaking stability for recovery?
So I do have to put this into context. For you to have a very good recovery when it comes to the purchasing power of Filipinos, you need to have stable inflation, slow and stable inflation. It doesn't necessarily have to be deflation. You don't necessarily have to cut prices. You just need predictable, low and stable inflation where income growth is actually exceeding inflation. So that's the other part of the equation. Yes, we were finally, or at least the BSP was finally able to put a lid on inflation and win the war against inflation with, I guess, inflation rate at around below 2% over the past 6 months, if I'm not mistaken. What is important now is to be able to generate good and quality jobs. In terms of quantity, there is no issue. As mentioned, we are not losing jobs as compared to, let's say, Malaysia, Vietnam, and Thailand, because we're not exposed on a manufacturing perspective. We do have a lot of jobs in the digital space, in the services space. It's just a matter of quality. A lot of these new jobs that are being created is in the gig economy. Case in point, our unemployment rate, I guess last July, was 3.9%. That is quite low in Philippine standards. That shows good job growth. But what you call the underemployment is still something that needs to be monitored.
Now, Aris, you were talking about we've seen BSP they do take action already, but we're seeing are we seeing that they're torn between protecting growth and controlling inflation? Do you think it's time to ease rates, or do you think it's still too risky and it's too soon?
I agree with the BSP. We need to cut rates soon. We do forecast another rate cut in December, mainly because inflation is just really low, and we have so much room to basically lower interest rates and drive growth ahead. What are the risks ahead? One, we don't think inflation is such a large risk. Rice prices have been stable so far because of the tariff rates on rice being cut from 35 to 15%. You have that disinflationary impulse coming from cheaper Chinese imports coming into Southeast Asia, bringing low prices of manufacturing goods in the region. So I would say inflation risks is not really a problem. What is the problem out there is growth. Like for instance, yes, we are insulated from the US tariffs, but we are not completely protected. We still have to shave off a little bit of our growth because of the US buying less goods from the Philippines. That's one. We do have to also take into consideration that investments in the Philippines is expected to slow down, and public infrastructure, as well as flagged by the Bangko Sentral ng Pilipinas, is also expected to slow down. If we look at it, consumption, the bulwark of the Philippine economy, is still trending below pre-pandemic levels. Exports of services is still wobbly a bit as we are competing with India. But then again, the risks are tilted towards more on growth rather than inflation, and we do think there is a lot of room to cut rates ahead.
Now, Aris, you mentioned about the lowering of the rice tariffs, which supposedly promises cheaper prices, but at what cost to our farmers and long-term food security?
So that is actually the trade-off. If we do cut tariff rates on rice, it does put a hold or at least a ceiling on the incomes of farmers. But we have to look at what is the right policy that would balance the interest of farmers and also consumers. Because as we all know, 9% of the household budgets is being spent on rice. So if rice prices is more expensive, consumers take, I guess, the brunt of the weight. So what do we do to balance these risks or to balance these interests? And I think the 2019 rice tarification law is a policy that points towards the right direction, where we do get access to cheaper rice prices, and whatever revenues that we get from the importation of rice gets reallocated to the farmers for them, or at least reinvested to the farmers to increase their productivity. We just have to make sure that those farm-to-market roads, those logistical supply chains are indeed come into fruition. We also need to take into consideration that what you call the middlemen, that they are being monitored, that they do not take advantage of the farmers and also the market.
But you mentioned, Aris, like, let's say, farm-to-market roads to make it better, logistics, supply chain. If that's fixed, do we still need importation of rice? Could we actually be self-sustainable and just, let's say, help our farmers elevate to the next level?
We do think that is the case. If we are able to invest on our farmers, we are able to increase the productivity of our farmers, and they are able to produce rice at a much lower cost. And what matters is basically, it's the market forces wherein we need to strike a balance where the farmers are able to garner a proper living, and at the same time for consumers to be able to buy their staples at an affordable price. So then again, for that to happen, we need to invest. We need to make sure that our farmers are able to reach out to our consumers on the proper manner.
Now, looking at our ASEAN neighbors, Aris, ASEAN economies keep touting resilience, yet global demand is softening. Are we truly strong or just surviving on momentum?
I do believe that we are very strong as a Southeast Asian bloc. And I guess case in point, we are, at least amongst everyone in ASEAN, free trade and free travel reigns. And I guess it's very good to point out that the number one export destination of Southeast Asia isn't actually the US. It's also not China. It is actually itself. Around a quarter of our trade is basically trade amongst our neighbors. So whatever happens in the global trade environment, if it does shrink, we do have our neighbors, we do have our friends to rely on to keep our economy going. So I did mention goods. I think it's also good to mention that the number one source of tourists in the region is also, in fact, itself. So with trade free in the region, with trade strong, and the ASEAN bloc being the second fastest growing economy in the world, we have a lot of, I guess, there is a floor under how much growth can actually slow in Southeast Asia.
Now, let's look at technology. We know that we cannot escape AI. Now, it's reshaping industries very, very fast. Do you think it will expand the opportunity or quietly erase the middle-class jobs we rely on?
So I think we need to think outside the box and think beyond the BPO sector. Whenever I visit the Philippines, it's always a discussion between AI versus BPO in the Philippines. I think we need to look beyond that and see what the benefits of AI are to the total economy. So there is this IMF paper that actually stipulates that around 1/3 of jobs in the BPO sector are at risk because of AI, but the other 2/3 could actually enhance their productivity and be more competitive on a global scale. But let's look beyond the BPO sector. The unemployment rate right now is at 3.9%. Let's put a bit more numbers into it. Around 4 million jobs are actually exceeding what the demographic trend would suggest. And what are these 4 million jobs? They are mostly on the digital space. They are mostly on the internet space and even AI. So, and these are jobs that are not in the formal sector, so they're not necessarily on the BPO side of things. So, in fact, if you see your job creation or see job created are what 4 million, and what is 1/3 of the BPO industry? I think the BPO industry hires around 1.5 million workers, so that's around 500 jobs lost. 4 million minus 500,000 is still a plus for the economy.
So, Aris, do you think it's safe to say that AI taking over jobs could be considered a myth? But before you answer that, Aris, before we continue, we'll just take a short break. Follow the money. We'll be right back. Welcome back to Follow the Money. Still with us is HSBC ASEAN Economist, Aris Dacanay. Now, Aris, I was asking you before the break about AI and how it's scaring workers that it could take over their jobs. But do you see it otherwise? Do you see it as a tool? Do you see more and more workers embracing it and using it as a tool to better what they do in their work and not necessarily being able to take over their job? So we were asking whether it's a myth.
So I would actually say, if I could put an analogy, I do think AI is like a chef's knife. It can make one chef in the kitchen the most efficient chef in the kitchen itself, but it could also hurt you. So I think when I came home a few months back, I was in a conversation with one of the call center agents in the Philippines, and I asked that call center agent, "Hey, what do you think of AI?" And he actually said that because of AI, he became more important at work. Rather than just receiving the complaints of customers or concerns of the customers and delegating it to, let's say, the proper office abroad, he now has the ability to type in what he needs to type in through AI and be able to respond to the customers appropriately, politely, in a proper tone, and perfectly with perfect grammar, basically. So because of that, that person became much more productive, much more efficient, and I guess contributes more value added to the supply chain. So again, it is like a knife. It can make you better, but it can also hurt you.
So basically a tool. So everybody can have it, but it really depends on how you use it, how you teach yourself and educate yourself on how to better use it as a tool to help you and not to stop you from what you're doing. Now, moving on, Aris, let's look at the BSP. It's been one of the most aggressive in the region. How does the Philippines' monetary stance compare with its ASEAN neighbors, and are we at risk of tightening for too long?
So I think the proper question there is there room for the BSP to cut more relative to everyone else? Now let's look at Malaysia, let's look at Thailand, let's look at Vietnam, Indonesia, and the Philippines. So whenever you cut rates, you're actually boosting growth through credit, through leverage. By lowering rates, a lot of people are more incentivized to actually invest because the cost of borrowing is much less. So are we over leveraged as an economy? Look at Thailand. Household debt to GDP is around 87% of GDP. Malaysia is between 70 to 80%. Vietnam is above 60%. Indonesia and Thailand are below 15%. Actually, for the Philippines, it's ranging between 9 to 11%. So debt in the Philippines on the private space is still pretty much healthy. There's a lot of room to incentivize more credit in the economy, to invest more in the economy, and basically, boost growth without the risk of, I guess, constraining the financial conditions in the Philippines. So I do think there is a lot of room to cut rates further.
But with the issues surrounding the country, with the flood control project issue, is it creating maybe a standstill or slowing down of economic growth?
That is one major headwind that needs to be monitored. And in the last monetary board meeting, the BSP actually wrote in its official statement that the risk of a slowdown in public infrastructure spending is a major headwind to growth, and therefore they decided to cut rates and basically make sure that monetary policy or private investment is able to pick up the slack, or at least make up for the loss in lower public infrastructure spending. Now, here's the thing. Let's explain the headwind with a little bit more detail. So what does it mean when you have slower public infrastructure spending? It's not necessarily a lower budget, but the fact that these projects, or at least the public infrastructure projects, these
Yes.
flood control, not only flood control, your railways, your roads, will now be subject to more public scrutiny moving forward. So the risk here that needs to be managed is that you also have these well-reviewed, these honest projects that may also undergo, heightened scrutiny. And I guess a lot of our policymakers may also hesitate in signing documents or signing approvals for these particular projects because of everything, the drama that has been put in place. So if you look at the numbers, July alone, even before this flood control allegations came to be, public infrastructure spending already fell by more than by around the double, by I think 16%, but by the double digits basically. And that alone can really be a headwind to growth. So let's provide some very quick estimates. Public infrastructure spending in the Philippines is around 5% of GDP.
What else do you think needs to be done in terms of creating a more robust economy, showing foreign investors that, yes, they could come in even with this looming issue of the flood control projects? What are your observations? What does your research say when you talk to people on the ground on what's happening here? Are they still on the wait and see in investments, or are they seeing a little bit of a positive movement in terms of, let's say, the investigation that's happening surrounding this issue?
They are mostly on a wait and see approach or wait and see perspective. I do think the Philippines is in a critical juncture where the economy shows not just the global market but also itself, whether it was able to push through with the necessary institutional reforms to improve institutionally as a nation. And I think the Philippines is going towards that direction, led by the BSP itself. I think 2 weeks ago or last week, the BSP initiated with the discussions on potentially easing the bank secrecy law. If you ease the bank secrecy law and I guess empower the BSP to look at deposits, we'll be able to hone a more transparent financial market, a more transparent government, and a more transparent economy, to be able to for investors to see that we are taking care of, that things are doing well for the economy.
Now, on the flip side, when you look at the local market, the local stock market, what are your observations again, and what, based on your research and what you hear on the ground in terms of the locals investing in our local stock market? Is it the same, or are we still seeing a lot of investors investing in the local stocks instead of putting it outside of the country?
So I'm not an equity analyst, so please do take whatever I'm going to say with a grain of salt. But I do think the stock market has moved sideways, and it's partially for two reasons. One, we are still in the midst of what you call a property market correction. where property prices are still stabilizing ever since a lot of the POGOs, if you may say, left the Philippines a few years back. And at the same time, we are also, again, investors are in the wait and see environment. They are not buying more. They are also not pulling out, mainly because they are observing what is being done amidst the flood control allegations.
Now, as the global economy cools, Aris, what will determine whether the Philippines achieves a soft landing or slips into a slowdown next year?
I do believe that we will achieve a soft landing. Again, we are insulated from these U.S. tariff rates. We have services to actually lift the Philippines. Services, again, is not tariff. We also have the BSP easing policy rates to make sure that private investment picks up the slack compared to the other risks in growth. We just need to make sure that we are spending our money on a fiscal perspective, that we are spending our money wisely, correctly, and that is able to invest to the future productivity of the Philippines.
Okay, Aris, now we go to the portion where we call it the rapid fire questions. You just have to answer yes or no. No need to explain your answer. We'll start with this. If AI takes our jobs, should robots start paying taxes? Yes or no?
Yes, the corporation that owns the robots.
Okay, is cooling inflation just economists' way of saying still expensive but less painful? Yes or no?
Depends.
Middle. Okay.
Depends on the context.
Okay. If rice gets any cheaper, should farmers start planting instant noodles instead?
Instant noodles cannot be planted.
Okay. Can the Philippine economy survive another tariff war without needing a bailout and a hug? Yes or no?
We need ASEAN, so no.
And Aris, finally complete the sentence. Money follows you when?
Money follows you when you do the right thing.
That's great advice. Of course, we all need to do the right thing. Thank you, Aris, for your insights and for joining us this afternoon. Thank you very much.
Thank you very much, Sir Robert.
And when talking about tariffs, trade, and global tensions, sometimes history reminds us what's at stake when nations turn inward, as former U.S. President Ronald Reagan once warned. When governments get too involved in trade, economic costs increase and political disputes multiply. Peace is threatened. And in a world of trade wars, high prices, and fast-changing technology, the Philippine economy faces both risk and opportunity. The real test is whether we can turn resilience into real inclusive growth, not just in numbers, but in everyday lives. I'm Robert Tan. Stay curious, stay sharp, and always follow the money.